In this week's update, yes, a change of character for parts of the US market, but no crash. Why is gold not rising? And was that just a top in the AI trade? My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Well, what a finish to the week. What was that just happened in the US? I'll get to that in detail in just a minute. But hands up those that are just getting a little bit frustrated by this gold sector and what it's not doing that we logically think it should be doing. It's a perfect environment for gold, right? Just couldn't be any better with all of the geopolitical conflicts, the rising debt, all those things that we know about. And yet gold is suffering at the moment. So what about the producers of gold? I mean, they're printing absolutely truckloads of cash. So why are their multiples so cheap? When in the AI trade, for instance, we're seeing enormous multiples when there's not necessarily revenue or profits yet. It's all a bit confusing. And if you look at copper, why can't the market see what's coming and price it in? It just all seems like a bit of a mystery when you look at it at the surface level. So it's important to understand this better and adjust realistic expectations, because if you do that, you'll get better buy and sell decisions and weightings that are more appropriate. And a lot of the confusion and uncertainty and maybe a little bit of panic will just melt away, because you'll learn to move more with what the market is actually doing rather than what you think the market should do. And you'll become a much better manager of risk. So it's important to have a better understanding of the US dollar and global money flows, at least at a superficial level. Now, I know that most people don't want to know too much about bonds or currency or anything like that, but at least if you have a very basic understanding, it's going to help with timing, it's going to help with patience, with all sorts of things. The other thing that's important is to understand the dynamics of the market, how and why cash does what it does. And basically, it principally goes where it's treated best. And so you must tend to try and look through that lens. So let's have a quick look at the US dollar and why it is mysteriously rising when everything looks like it's heading in the wrong direction for the US dollar. So basically, we've got two timeframes working here. We've got cyclical demand, which is, think of it as shorter term, weeks, months, and we've got the long-term structural decline. And I don't think too many people have any trouble understanding that the US economy is in long-term structural decline. Part of that long-term structural decline is this de-dollarization process that many people have been speaking about for years. But that is a process that's very slow and it's very uneven, and it comes and goes in importance. We've got commodity markets experimenting with non-US dollar contracts for oil, for all sorts of things, agricultural products. So that is another source of unexpected influence. But the bottom line, and what you've got to realise, is that the exchange rate of the US dollar is driven by short-term money flows, not by the long-term structural decline issues. And I think that's the thing that's tricking a lot of people up at the moment, and why they're hanging out for gold and gold stocks to rocket off to the moon, and it just never seems to get here. The message is it's coming, and an understanding of what is going on at the moment with currencies will help in that process a lot. So the cyclical, shorter term, faster factors are around higher asset returns attract the capital flows. It's not a lot more difficult than that. And that's why I said money flows where it's treated best. And at the moment, higher asset returns or potential higher asset returns in the US dollar will attract capital. The US dollar still has a safe haven image. I don't get that at all, but it is what it is. And that is the reality. That will gradually fade away, but we're talking perhaps decades there. So you can't expect the US dollar to fall continuously all the time. There will be periods when it will appear to be heading in an illogical direction. And of course, interest rate differentials and economic growth come into very, very substantially as well. And currently those long-term factors and shorter-term factors are working in opposite directions, and the shorter-term factors are winning. And that's why the US dollar would appear to be illogically going up. Then we've got US equities outperformance. And the reality is, if you're an overseas investor and you want to buy US stocks, then you have to buy US dollars to be able to do that. So that's keeping a floor under the US dollar. And there's no question that the US equities market has done so much better than everywhere else around the world. We've got safe haven flows. The US dollar is the most liquid asset, and especially that's the case during geopolitical crisis, and we've got that in spades at the moment. So the US can run huge deficits, and we all know about those because global capital keeps financing what they're doing for all these other reasons. We've got a global savings glut coming from certainly China and to a degree Germany, and that supports the US dollar, despite the fact that the US is continually ratcheting up their debt level. So when you kind of understand it on this level, it makes a little bit more sense, and it allows you just to relax a bit more with the gold trade, with the other commodities trade, those sort of things. So this debt sustainability, which would logically appear to be a real problem for the US, it's sustainable. It is just that. It's sustainable as long as confidence holds. And for now, confidence holds. And one of the reasons for that is that there's no credible alternative at this point in time. And there probably won't be for perhaps again decades. So the long-term confidence in what the US is doing in all respects is slowly eroding. But global capital at this point in time still trusts the US dollar more than any alternative, including gold. Now, again, that might seem illogical to some, but that's the reality. So there are plenty of long-term risks for the currency for the long term, but they're not drivers of today's foreign exchange. They're just not. So there's no point in agonising about it and waiting impatiently for it. Just recognise that that's what it is. The long-term game for gold and other commodities and the AI trade and all that sort of thing is completely unchanged. Nothing has changed. That's what you need to understand. It's just the time frame is a bit unpredictable. Next week, I'm going to be doing something that hopefully will be helpful for everybody. Again, just not to understand in detail, but just to understand at a very basic surface level, is what's the probability outline for the next decade for the US dollar? What are the phases that it may move through? So why I understand this is important, just to put an exclamation mark on this, realistic expectations in investing, absolutely everything. And if you don't understand that, then please accept it that that is the case. And so having realistic expectations about timeframes and directions keeps you calm and objective. And if you're calm and objective, then you are going to be a much better investor and you're going to be ready to seize opportunities. There's just no question about it. So how can we better navigate these markets that are difficult because they're volatile? Not because there are a whole bunch of things that are unknown. It's just that they're volatile to an unexpected degree. And we saw a lot of that on Friday night. So what can you do, particularly in commodity markets, which we know long-term are all offering incredibly attractive opportunities? So how do we trade them? Well, one of the things that you can do is to build a bit more fat into your timeline. If you buy gold stocks, don't expect them to go up next week or next month or even next quarter. Give them some more room to move. Don't set your expectations that because I bought, then it must go up. It might go down first for a few months. So just understand the importance of having a realistic timeline and expectations. Be clear on your group weightings. Talked about this a great deal. Be very clear on what your weightings are for the different megatrend sectors and work your way towards that. You don't need to push all your money into the middle of the table straight away. Just take your time. If you build your portfolio over months, who cares? If you do it well, it'll pay you back in spades And just recognize that this is not a one-way trade at the moment. AI has been screaming off the map, started a big correction on Friday night, or what will probably be a big correction on Friday night. Commodities should be going up, but they're not. They're going down, but it's just a matter of time frame, nothing else. And what needs to happen here with commodities is that the supply and demand characteristics for the various commodities needs to outweigh the drag being provided by the US dollar. And I don't know whether the US dollar is going to go up or down. For me, it's unknowable. It's actually dangerous to try and think about it because it plants seeds in your mind about what will happen, and that can cloud your objectivity. But that's what needs to happen. We need to get more enthusiasm for the supply and demand side of things and overcome the US dollar drag. So therefore, we need, if you think about that logically, we need an extra advantage. We need something else working for us. And one of the things that you can do is prepare for weakness at an even greater level, an out of favor weakness. Now, that may mean that you need to wait longer. But again, that's okay. We're playing a multi-decade game here as investors trying to build wealth. So what if you've got to wait another month or 2 months or 3 months to get an even weaker entry point? Because that's where you make your money, on the entry point. So basically, you've got to load up when it's tough to do so. And I'm sure you've heard that, read that over the years, but maybe didn't quite think about what it meant, because it's actually really hard to do. It's incredibly difficult to do because prices have been moving against you for weeks or months. All the narrative in the media is against you, telling you how bad it is. So it's really hard to do, but it's the best time. And this is where nearly everyone needs some level of guidance or input to point to the fact that here's an opportunity. It may not be the absolute bottom, but gee, in terms of risk and reward, we're much, much closer to the bottom than we are to the top. And so if we start accumulating at these levels, then it should be a good thing. And it's pretty obvious when someone spells it out. But when we're in the heat of the battle, we just conveniently forget all these perspectives. So nearly everyone needs some sort of level of guidance and input. And just on that, we had a special offer a couple of weeks ago, but then we had a gap in the weekend videos for a couple of weeks for one-off reasons. And as a result of that, we're just going to extend it just a little bit longer, but it's going to close very soon. So what we do in the Insiders Club to help people with all the things that I just talked about on the last slide, all the incredibly important things that are worth far more than just recommendations. So we provide a daily perspective, which is refreshed without any bias or agenda. And that's really important. That's hard to find. It's not anchored to yesterday's view. It's very current. I've been doing this Sunday video now for nearly 18 years, every week. So if you've been watching for any amount of time, you know that there is no bias. There is no anchoring to past events. I'm just giving it to you as it's happening day by day. So it's purely about gaining the best possible outcome for members, but that varies. So you need to build your own plan. You need a clear process that's built around the mega trends, around quality stocks, and around money flows. The entry and exit plans are important, but managing psychology is the most important part, and you get a lot of help with that. So the end result we're looking for is a high growth approach, high growth stocks, unapologetically, but with a really, really strong focus on managing risk. And the results are visible on our website. So just to recap, the very short-term offer, $149 for the first 2 months, and then $249 per month if you find that it's a service for you, if it works for you. There's no lock-in. You can try 1 month if you want to, and then make your decision from there. And it's closing very soon. So what's included? Entry and exit recommendations, daily market perspective, videos, a detailed phone onboarding, and lots of email support. So It's real value. It's a plan that you create. It's not a plan that I give you. You create it with a railway track to run on. You get a lot of execution support, and it's certainly not just tips, because they're not worth very much. All right, now I just want to start with looking at a couple of charts. This is MU, Micron. I'm sure a lot of you have heard of this US stock in semiconductors. If you go back, just think about those last two candles not being there. The trend was completely unsustainable as it stood on Wednesday. But the fundamentals remain really, really delicious. They really do. The growth is really powerful, and it looks very, very sustainable because they've moved up the technology food chain, and it's still cheap. But the dynamics are that it just got way too extended in the short term. And so this is just part of the natural dynamics of the market. And so we started to get a pullback. And that's just absolutely normal. It's actually healthy. You want to see this kind of reaction. So rather than looking at Friday night and all the horror headlines that I've seen in the last 36 hours, look at this as a really good thing, because it's going to clear some of that overhang and set up the next opportunity. And just while I'm on that, just forget all that rhetoric of the so-called experts. Just think about this. They don't know what your plan is. They don't know what your time frame is. Could be weeks, could be years. They have no idea of your tolerance to volatility. So how can their opinion be suitable for you? Or how likely is it that their opinion is suitable for you? So don't go surfing the net looking for someone to tell you this, what's going to happen next. Because what it means for one person is going to be completely different to the next person. It's a fruitless exercise. You've got to learn how to develop your own set of railway tracks with guidance, and it's really easy. And then just plonk yourself in an environment where you can stay on those railway tracks. It's not difficult. So we've still got an incredible wealth-creating opportunity across several mega trends. We just need a plan that's built around managing risk for us. And if you think that MU is an outlier, then think again, because I could show you 100 of other stocks that are behaving like this and have an incredible, delicious future. Now, just to make the other point that I think is really important about Friday night, this is an ETF, doesn't matter what it is. This was the overwhelming theme. The volume signature was pretty muted. This was not a massive volume spike. It was here on MU, which is an individual stock. The profit-taking overhang was just so great on. But this is much more like what we saw, and I've looked at hundreds of US charts over the weekend. Yes, a couple of sharp days down, but the volumes. So all the really strong volumes are on the up. Here, the start of this one here and this one here. That's the important thing. Just coming back to gold, this is one of my favorite US gold stocks. And gold stocks got hit very hard, as you can see, on Friday. This looks nasty, breaking support, all sorts of dreadful things. But look at the volume. There's just not a lot of emphatic selling behind what happened on Friday. So keep that perspective in mind. And of course, every week, the most important thing that we can stress is that you need to get all your ducks lined up. You need to have all the various elements of advice that you need before you take action on anything, and certainly on anything in this video. But the other message is that it's really easy to do. I think a lot of people think that building a plan and sticking to it is just all too hard. Well, I can tell you it's not. Let's look at American stocks. The S&P 500 was down 2.6. The Nasdaq, with the belting that some of the AI stocks got, was down 4.7. The Russell was down 3. So it was a nasty session in terms of price. But you've got to distinguish between what is a major top in the market and what is just part of the normal market dynamics. So yes, we saw a change of character in some parts of tech that there are a lot of stocks in tech that look like Micron. But it's normal and it's healthy, so don't worry about it. Don't go changing anything as a result. You might just want to maybe raise a bit of cash so that you've got some attack capital. But don't sell your winners. Sell your worst stocks to create that attack capital. So what was it all about? Well, it was a hawkish jobs report. Jobs created were way more than was expected, double. And that was the trigger for an inevitable correction. It had just gone too far, too fast, that sector. And the US dollar index finished above 100. So we're back up in that territory again. And just to reiterate what I did before, so this was the Forex drivers, the current day drivers of probable higher yields. The market is now pricing in a rate hike by the end of the year, not a rate cut. So it's been a big, big swing around because of inflation. The safe haven status, the US exceptionalism in a number of areas, all those sort of things. And when you stand back and look at it, hopefully through the lens that I've been able to provide you today, it's very difficult to conclude that the US dollar is probably going to go higher because those short-term Forex drivers are stronger than the long-term structural trends of de-dollarization. So what does that do to your expectation around commodities? Well, if you've gone all in on commodities, then you need to recognise that maybe the time is just not quite yet. It might be next month, or it might be a couple of months, or it could be next week. I don't know. But you've got to recognise that the momentum and the fundamental drivers are for the US dollar to probably go high. But make no mistake, the commodity trade is just lying in waiting. Nothing has changed. It's just the short-term Forex drivers around the US dollar are clouding the issue. So don't lose sight of what's going on, that you might want to adjust your weightings and your cash levels to suit who you are, and that's what's important. It's not what I think or what some 100 other commentators think. It's what's most appropriate for you, and that's what I can teach you how to do. So global capital doesn't see a better alternative yet, and realistically there's probably not going to be one for some time. But that doesn't mean that commodity prices can't explode away, because there are other factors that will overcome that drag. And the 10-year yield went back up above 4.52, so that kind of combined with the trigger for the tech stock sell-off. But look, the VIX only went to 21.5. This was not panic selling. The VIX hardly moved. The volumes were not high by and large. So I think you just need to take a pill and calm down after Friday night, because it's not as bad as it looks on the surface. All right, let's go and look at some charts. We'll start with the Nasdaq composite. That's the Nasdaq comp on a weekly chart. You can see it was fairly sharp, but it all really happened at the end of the day, or the end of the week, I should say. So that's a fairly emphatic move. And we may get some follow through in the next week. When you stand back and you look at it through the right kind of lenses, this is not as nasty as it looks. It really isn't. Next, the consumer discretionary versus consumer staples. Yeah, it was down a bit, didn't move a great deal, didn't fall off a cliff at all. Semiconductors got bound up in that, but semiconductors had just been running so hard that this is hardly surprising. We were starting to get up towards doubling from the start of April, so 2 months, and the semiconductor index had something like doubled. Of course it's going to sell off. And once that trigger starts, then it becomes a cascade very quickly. We look at the individual sectors. This technology had just gone off to the moon, came back with a thump, but nothing's changed. And that's the only sector that's been above the S&P. Everything else has been trending down. So technology is still a very, very important area. And in the Australian market, materials had managed to scramble above energy. to the top of the pile, but we also saw a very sharp rebound in the Australian technology sector as well. There's the ASX 200 in the middle of the pack, and below it, we've got small caps, we've got telecoms, we've got finance, and of course, bringing up the rear still is healthcare. The S&P, that's it on a weekly, so just a bit of a milder version. The energy sector, this is on a weekly, so we're consolidating in energy. The market seems to be less and less driven by what's happening in the Middle East. And finally, that's the Russell on a weekly basis. So turning now to the Australian market, our dollar 69.75, so we're back down under 70 with that US dollar strength. Our market was down 1.2% for the week. Monday we're closed nationally. If the US market bounces back on Monday, which is entirely plausible, then I don't know how we open on Tuesday, quite frankly. So I have zero expectations for what's going to happen in Australia. Turning now to precious metals. Gold was down 4.6% for the week, and we're now down to the bottom of the range that I was looking for gold to consolidate in. In Australian dollars, we were at, if you can think back a few months, we were about 7,600 in Australian dollars. Now we're down almost to 6,000, so it's been quite a large move, but it's still very profitable territory for Australian gold producers. Silver was down much bigger, down 9% to 67.30. We'll look at those charts in a minute. So for gold, this is the level that I've been pointing to for about a month now, 43.80 to 48.90. They're the key support and resistance levels. We've just broken through, but not by much, that support level. And by no means am I suggesting that gold could not fall further. But I think it gets harder and harder, and we're much closer to the bottom on gold than we are to the top. And as I've been observing for a number of weeks now, gold's not going to move until there's an outcome to the war, which is kind of a bit perverse, isn't it? You would think gold would be doing really well while the war is bubbling away, but it's actually the other because of that whole safe haven thing, that whole safe haven image around the US dollar. If we look at the actual gold producers, it's broken key support in a pretty emphatic way. So the odds are there's going to be a bit more pain yet. But is this trade dead? No, not by any stretch of the imagination. The end outcome for gold and the gold sector remains absolutely unchanged. So this is where it's so critical that you've got clarity of purpose, what you're trying to do, manage risk through your weightings, how much are you going to allocate in percentage terms to the precious metals trade. And these things become non-negotiable. You cannot traverse the environment that we've got ahead of us for years to come unless you have clarity of purpose around what you're doing. It's impossible. There's a very good chance you'll lose money because the market will just trip you up. It'll go one way and then the other, and you'll get totally confused. And I'm sure that most of you that have been in the market for a little while will know exactly what I'm talking about. Which is probably why you're looking at this video. You're trying to get clarity. But clarity comes from you being guided to putting together something that'll work for you, not something that's working for someone else. You've got to understand that distinction. So let's jump in and first of all, just look at the currencies quickly. So this is the US dollar index. So you can see we've been trading in this band between 96 and 101 now for quite some time. We go back to April of 2025. So this is a really important support and resistance level. And we're back up towards the top again. But the Australian dollar, of course, has started to slip away as a result. But let's look at the gold and silver. So this is the Australian listed GDX for gold producers. We're still in a big overall consolidation. But unless things turn around on Monday night in the States, then we're going to see selling pressure in the Australian gold market on Tuesday. But look, Who knows what will happen? It's quite a long way away. This is GDXJ. So this is what was listed in the States. This is on a weekly basis. And you can see how emphatically the gold stocks there fell. So that was Friday night. Let's go and look at the gold and silver prices. So there's gold on a daily basis. So we're really getting down to, we're just popping through the bottom of this support level that I've been pointing to for some time. But look, tiny little overruns by this, just overrun the 200-day moving average. They're not a showstopper. They don't guarantee that gold is going to continue lower. And the same with silver. Silver's obviously a lot more volatile. Turning now to other commodities. The price drivers for different commodities can each assume dominance for different periods. You can have strength in precious metals and then strength in copper and then something different next week or next month. So you've got to understand that that's part of the normal market dynamics. Just because there's a very good case for things going up doesn't mean they will. So it's about supply and demand. It's about the US dollar direction. It's about global liquidity and the growth, that what's called the M2 growth, the growth in money supply. Liquidity is just so critical. Then we've got ETF flows, whether flows are going in or out. We've got positioning in the options market. There are a lot of working parts here. And above all that, just beware the crowded trade, particularly in commodities. A lot of people had expectations and had piled in. And then, of course, we've got supply chain risk as well, which can really factor into the price of the commodity, and technological advances. So there are lots and lots of cross currents for commodity prices. We finished the week with gold at $6.25 and West Texas Intermediate crude at $90.25. Just touch quickly on Bitcoin. It's dropped into a bear market. It's emphatically broken support, key support, 67. And 59 is a crucial line in the sand. That's key support level. So Bitcoin needs to do some positive stuff pretty quickly, or it could get very nasty. There's the copper chart. We're still consolidating near the peak. So there's actually nothing wrong with the trend in copper. It's just doesn't appear to be the enthusiasm you would expect for copper stocks. There's the crude oil chart. So the final message, we had an extreme run in some parts of the US market. We have to get a consolidation. So don't panic about Friday night. It's normal. It's healthy. They're just doing what they always do. Animal spirits kick in. People get ahead of themselves. It goes too far, and then there is a trigger. On Friday night, the trigger was the jobs report, but it could have equally been another 6 triggers. And then the market's correct. But the businesses and the opportunity, they're unchanged. Nothing has changed. So you don't need to dramatically do anything different. You just need to adjust your expectations. Managing risk becomes more essential in this sort of environment because you've got to keep yourself calm and objective. And you can't do that unless your expectations are realistic. This is where keeping your expectations is just so critical. You've got to keep yourself in an environment where your expectations can't get out of whack with what is normal. We can do some things. We can wait for lower, more extreme entries. You're not going to miss out. There's more entries than you can poke a stick at. Get rid of that fear of missing out. When we're in a more volatile, more tricky environment, then be prepared to wait a bit longer and get a better entry because you'll probably get it. We can stage our entries due to the higher uncertainty, buy smaller amounts, and avoid extreme weightings in anything, be a sector or a stock. So basically what I'm saying is just play conservative, but don't lose sight of the incredible future that's in all the megatrends because it hasn't changed. That's what a megatrend is. It's something that's sustainable for decades. So if you want to tap into that incredible future, then this is why you need an evolving perspective and lots of support. Because unless you're immersed in the market will get you. It'll twist your psychology and it'll get you. So I'll leave it at that for this week. Plenty of food for thought. The outlook is as exciting as ever. There's more information on the website, and there's my email address. I'll be back with you next Sunday. Cheers.